Good afternoon, everyone. Welcome to the third seminar in the Evershare Sutherland Food and Beverage Client Training Programme. Really glad to have you all with us today. I'm Amanda Parthland and I'm the head of the Evershare Sutherland Food and Beverage Sector Group. And today's session will focus on the really important subject of the journey to net zero, climate change and corporate value. The session will be presented by a selection of our global specialists and will be led by Louisa Deese. Before I hand over to Louisa, just a quick reminder and request, please, to put any thoughts and comments into the Q&A box, and we'll either pick those up as we go along, or we can come back to you following the session if we run out of time. So Louisa, I'll hand over to you now, please, to start the session. Thank you.
Thank you very much, Amanda. Again, thank you everyone for participating and attending today. First of all, I would like to extend the apologies of Michelle T. Davis, who was due to take you through this training webinar today. Unfortunately, she's not feeling very well, so she's asked me to step in. Alongside me, however, you'll be pleased to know that I have Stephen Kitts, who's the managing partner of our Asia business, Stephen Hopkins, who's the head of global client development, and also Ram Sunkara, a partner in our US business. So if I could just move to the first slide, please. Thank you, Mel. So what we really want to do with today's kind of training webinar is to give you an idea of the landscape which is around decarbonisation, and not just decarbonisation in and of itself, but also ESG, so environmental, social and governance. And you're going to probably have heard the term ESG more and more often in the last couple of years. I would say Greta Thunberg has had a lot to do with that. The climate activism protests that we've seen in London and around the world. And also with COP26 being in the UK this year, there's certainly been a huge eye-opener in terms of what climate change, climate risk, and all things climate have to do and how they impact on businesses. So if we can move to the next slide, please. So there are clearly two key drivers for decarbonisation and climate risk reduction, and we're setting aside the kind of the personal consumer drivers, but we're looking more at you as a business. So there's the regulatory drivers, and we're going to come on to those in a little bit more detail in a little while, but there's also the stakeholder pressure, and this is coming from investors. So we're seeing a huge move now by banks, commercial banks, towards ESG compliant investing or lending, the issuance of green bonds and transition bonds, as well as sustainability backed loans. And a number of our clients within the consumer sector have been looking at raising sustainability backed loans, which are with specific KPIs against their own ESG goals and objectives. Customers. So pressure from customers is alive now more than ever, and they are very much voting with their wallets and with their feet in terms of where they're choosing to buy their food, their beverage, or any other consumer product. There's also yourself as a customer. So wherever you sit within the supply chain, you will also be feeling pressure from those above you or below you within that supply chain. And then finally, there's the pressure from employees. And we're going to speak a little bit more about this later on when we get to the real data of the survey. And again, I'll give you a bit more information around that. But we have found that employees themselves, whether already within a business or whether seeking new employment, are very much now assessing whether they choose to or wish to work for a company because of the way that that company behaves in terms of ESG, whether that's in the acquisition of renewable energy, all the way through to things like their diversity and inclusion agenda and their beliefs on human rights and the supply chain. Next slide, please, Mel. So climate regulation, and we'll just quickly move on. So things are happening more quickly now than ever before, and we're seeing the pace of adoption in some jurisdictions and markets accelerate more than in others, and also the format that adoption is taking also differs between certain countries. Before I dive into this slide, I think it's clear, very important that I point out to you that TCFD, so the Task Force on Climate-Related Financial Disclosure, which is the primary kind of mandatory reporting and disclosure scheme, is just one of 6. Now, I'm going to run through these, but please, if you want further information on them, you can reach out to me after the webinar. So we have the GRI, which is the Global Reporting Initiative. We have the CDP, which is the Carbon Disclosure Project. We have the SASB, which is the Sustainability Accounting Standards Board, the TCFD, which is the best known, the IIRC, which is the International Integrated Reporting Council, and then WEF, the World Economic Forum. And WEF has produced the stakeholder capitalism metrics. And what WEF has sought to do there is converge the metrics from all of those other schemes that I just outlined, and it will hopefully become the set of metrics for corporates. So I would urge you to go onto the WEF website and have a look at those stakeholder capitalism metrics. But if we move now to TCFD, as I said, things are moving quickly, and there is a mix of voluntary and mandatory reporting and disclosure that is within the market at the minute. So what is live now is that premium listed issuers have been required to publish in line with TCFD since the 1st of January this year. There are draft regulations in circulation for TCFD reporting in relation to pension funds, and we have an article on that within our climate resilience web pages, so please do take a look at that. There will be an open consultation for TCFD reporting by publicly quoted companies and large non-listed companies and large limited liability partnerships. So that will come into force from April 2022. So we, as Evershed Sutherland, will have to disclose against TCFD as of April 2022. And we know that later this year, there will hopefully be a further consultation on TCFD for asset managers. And as I say, that is expected mid this year. If we can move to the next slide, please. So I'm not going to go into detail, but you can see that again here on this slide, there is more regulation coming, being looked at. It's a mix of what is relevant to corporates, but then also financial institutions and asset managers. And it's very clear that you appreciate that there is that split. So whilst there is a lot of existing regulation and reporting requirements on the financial institutions, it is the corporate side of things which is picking up pace now. Next slide, please. So this isn't just relevant to the UK, and despite Brexit, there is still a lot going on. So you'll see there what is relevant within Europe. In the last 10 days, we have had the European Union publish another set of key pieces of legislation, and these include an EU taxonomy delegated act, and most importantly, a proposal for a corporate sustainability reporting directive, the CSRD, as well as a set of amendments to more financial products such as UCITS, AIFMD, MiFID, solvency, etc. But it's that middle one there that I really want to focus on, which is the Corporate Sustainability Reporting Directive, the CSRD. And we're going to be running a webinar on that in the coming weeks as to how the CSRD will impact on corporates within not only Europe, but the UK. You'll see there, the United States, obviously, with the advent of the Biden administration and his with the US re-signing to the climate agreement, the Paris Climate Agreement, there has been a lot of traction and a lot more movement. And just in the last couple of days, in fact, at the end of last week, the Biden administration held a mini climate summit. And John Kerry, the climate envoy for President Biden, stated that the US would most likely adopt the TCFD. So they would be following Europe in that respect. And we know that the SEC, etc., is also looking at frameworks for listings. Hong Kong and Singapore, there are currently consultations on mandatory climate disclosures for asset managers. Canada is expected to adopt the TCFD, and New Zealand already has adopted the TCFD, and that is just the tip of the iceberg. As I say, it does differ from jurisdiction to jurisdiction, and again, there's a list of how the implementations are progressing on the website if you would like to take a more detailed look. Can we go to the next slide, please, Mel? And the next one. So, climate change and corporate value, that was the title of the joint report which we did with KPMG, and which the data of which is going to form the analysis which will follow me at the tail end of this event. But what I really want to talk to you now are, what is the risk? How does it impact on your corporate value if you do not start to look at these things now, whether that's through the mandatory or the voluntary disclosure and or reporting that you require? So I think it's important at this stage to differentiate, as the TCFD indeed does, between physical impacts and transitional risk. So physical, these emanate from climate change and can generally be event driven. And so they're kind of categorized as acute. So we're looking there at typhoons, etc. Longer term shifts, which are chronic, are, for example, precipitation, easy for some to say, patterns and temperature, and also water, so rising sea levels. And I think, a key kind of fact to think about is that 2/3 of all fresh water is used in agriculture, something which will undoubtedly be very close to all of your hearts on this call. And with demand for water set to rise by 50% between now and 2030, water scarcity is a likely scenario and something which we need to be assessing our risk of exposure upon right now. So what exposure are you as a company likely to have with that lack of water? How will that impact on your agricultural business? And what do you need to be doing now in terms of agripreneurship to try and combat that? So there is now a requirement and a greater desire for transparency in what companies are doing. So please note that regulators and investors are really hot on greenwashing. So the days of being able to make bland statements are over. You're going to have to be able to report to a verifiable standard on what you are doing. And just last year, the European Union conducted a spot check of 300 plus companies' websites looking for greenwashing. So looking for false use of terms such as eco-friendly or sustainable. And that has both reputational damage, but also impacts on your share price as well. So what are the impacts? Well, we've got balance sheet impairment, a reduction in net asset value, and we are starting to see that in very high carbon intensive sectors, and I know that Ram may come on to speak about this later, so particularly looking here at oil and gas and coal, there is a risk of stranded assets. So as I said, with the drive for institutional investors and banks and lenders to really revise what they are lending to or investing in so that it is ESG compliant, there is a risk that if your asset falls into that dirty category, there will be a lack of funding and financing, and it would then become a stranded asset. So how is that going to impact on your balance sheet? The key thing here is this is a transition. We don't expect everything to change overnight. It is a journey. And I think that most investors do recognize that. And that therefore, what is really essential is that you as companies have a strategy and a roadmap which has verifiable milestones on it. And those are reporting milestones. Our view is that the TCFD and similar regulation, whether it be whichever one of the 6 you choose to kind of follow, will become a toolkit for you to achieve a lot more in terms of what you can deliver around decarbonisation strategy and disclosures. And the key is that decarbonisation and climate risk mitigation are delivered. So what you need to be doing now is delivering and getting on and doing it. Next slide, please, Mel. So what can you be doing now? So I think that the first step is to conduct a sustainability legal risk assessment. Now we have developed one with Conexo, but this is something that you yourselves can also do. You need to look at what are the hotspots, what is the risk of inaction, and those who fail will be left behind by consumers, NGOs, investors, essentially everyone across the whole gamut of stakeholders. So what are the tools that you can be looking at? So there's disclosure and compliance systems. You could be looking again at your employees and your senior management skills training, upping those skills of your senior management and boards, and we'll come on to that later on. Remuneration strategies. We've seen very much over the last couple of years how CEOs and boards are beginning to link remuneration to a delivery of certain ESG goals, and that is being put into corporate reports. Contractual frameworks, debt, and other sustainable financing. At present, there is an awful lot of capital out there that is wanting to be invested in a green home, and you are able to access that, whether, as I said, that's a green bond or a transition bond, depending on where you are in that journey. So there is an awful lot that you can be doing now just to get ahead of the game and before everything becomes mandatory. And I think that is key. It's all in the preparation. There are areas that we are actively involved in. So all of the things on this slide are things where we are actively working with clients at the moment. And we're making sure that our customers' supply chains, contractual frameworks, due diligence are ESG fit for purpose and future-proofed. And I know it wasn't 100% ESG related, but there was certainly some talk around the fact that the Deliveroo IPO did not gain the success that it thought it would, partly down to the fact that people questioned human rights of the gig economy. So if we look there at Uber drivers, Deliveroo drivers, so looking there at the human rights, and that was thought to be one of the minor but yet reasons that the Deliveroo IPO did not reach that share value that it had expected to. Next slide, please. So in a nutshell, this is what you have to be as a business. You have to be climate fit for purpose and climate future-proofed. Next slide, please. And the next one. So this is a new approach to doing business. There's no two ways about it. You have to have full visibility of the key risk areas, and you have to have the ability to evaluate these. That means data, data, data. You have to be able to assess the impact on your strategy in terms of engagement and risk management, and so where your litigation team would come into it, or your contract frameworks team. Now, your first step is, as I said, to conduct that sustainability legal risk assessment. You need to measure your carbon footprint from cradle to grave. And if I think about this in terms of, the sector within which most of you are sitting, that is starting right at the start with agriculture, the raw materials suppliers, the manufacturing, the packaging, the logistics, the retail and business channels, the consumers, and the end of life of your product. That is a large supply chain that you need to essentially be doing your due diligence on. You need to how to access the transition economy for, again, looking at value enhancement. What we're seeing from a number of our clients is that they're actually changing their business models to access this new world of decarbonization, the transition economy. They're introducing new business areas or refocusing their existing business area. So for instance, do you need to change your product portfolio? Should you be evolving your packaging? Do you need to look at cleaner logistics? Do you need to be creating carbon neutral brands or products? Do you need to be looking at the way that your factories operate? Could you be looking at renewable energy? Could you be looking at anaerobic digestion? And I know that Ram will come on to a few of these things when he looks at how you can decarbonize your business through your electrification and purchase of power purchase agreements. A real example here is that clients are thinking about either the end of life of a product, if they are producing a product, or how their product is going to be used and how sustainable it is. And that is something which consumers are demanding more and more of now. So your product may have a very low carbon footprint in terms of the way that it was produced, but what is the carbon footprint of that product when it is used? And what is the carbon footprint of that product when it comes to the end of its life? And one of the common examples that's always touted here is the Tesla battery. We know that during the life of a Tesla battery, its carbon footprint is minimal because that is its purpose. However, lithium at the beginning of a journey, human rights issues around that, and then we do not yet know in terms of the recycling of these batteries what the impact of that is going to be on our ecosystem. And we also know that consumers are looking at the way that they have their products delivered to them in terms of packaging in supermarkets. So just last week, Asda stated that it would no longer be pre-wrapping its chickens. Now, I don't know how that's going to work in practice, but again, it's this move towards packaging. So we no longer want our peppers packaged in groups of 3. We no longer want punnets for our apples and pears. So again, it's thinking about those packaging, and there's huge plastic regulations across the world now, which you have to be aware of. Next slide, please. So the most important thing, and quite rightly, is the focus on risk and protecting value and reputation, and that is very important. Climate change action is not philanthropy. The interests of shareholders are converging with the needs for greater sustainability, and businesses can do what's right without sacrificing shareholders. It does have the potential to create value enhancement. Business models and strategies need to be capable of identifying this and capturing that future value enhancement. You need to avoid missing those opportunities because the time is now, and we are seeing companies already restructuring and refocusing their businesses. Next slide, please. So as I said, data is key. And we have kind of put this into a simple acronym, the 3 C's: certainty, clarity, and comfort. Next slide, please. So quickly coming on to the report which we produced and which very kindly Stephen and Ram are now going to take you through the data results of. Last year, in November of 2020, we were very pleased to launch our joint report with KPMG entitled Corporate Change and Climate Change and Corporate Value, what corporates are really saying. And it was launched at the Green Horizon Summit, which was essentially a mini COP, given that COP26 was rescheduled to this year. As part of that, we conducted a survey of over 500 of the largest companies globally, and it was C-suite respondents. And we received input from Mark Carney, Marco Settembri of Nestle, Jim Barry of BlackRock, and a number of others that you can see there. It was the first of its kind in terms of the empirical evidence in which we were able to gather, and it did gain a lot of publicity and traction, which obviously we were very pleased with. And as I said, just yesterday, we were quoted again in the Telegraph. We're now working on version 2 of the report, which we hope to launch at COP26, and that will have a pure focus on the people factor. So looking there at the upskilling of your boards, of your management teams, and on how to attract staff and employees. So I would now like to hand over to Stephen Kitts, who is going to take you through the remaining part of this webinar. Thank you.
Thank you, Louisa. And if you could go on to the next slide, please. So I'm going to share with you some of the data that came out of the report, which we've just mentioned. There's clearly been a lot of talk about ESG and climate change, and for all the reasons that Louisa has mentioned, it's becoming extremely high profile and important. This slide here shows that there is the majority of executives in large corporates believe that they do understand that they've got climate-related risks in their business, and you'll see here about 87% feel that they understand that extremely well and will need to do something about it. And I think it's fair to say there's very much a day of reckoning now coming for the corporates, because they are beginning to understand that climate-related risk will have a financial impact on their business. The top 215 largest companies in the world have quantified that over the next 5 years, climate risk could cost them about $1 trillion US. And then if you look to the end of the century, it could get to $63 trillion. So you're talking about some significant issues here which affect the financial viability of some of these businesses. And you'll see that climate risk here breaks down into two particular features. There's the physical risk that arises through extreme weather events, and we've all seen in the news that these seem to happen more regularly now than they might otherwise have done. And then you've got this transitional risk where you have stakeholders who are keen to ensure that people they deal with abide by climate risk or take it seriously, and if they don't, they'll disengage. So that third party pressure is becoming highly relevant, and not only is addressing climate change the right thing to do, it's clearly good for business as well. The other observation I'd just like to make on this as to how this has become a bit more high profile, or a lot more high profile, is that there are some parallels with what's happened with COVID. Some might say that COVID has been a bit of a dress rehearsal for climate change, and has accelerated the focus on that in recent times. And of course, there are some similarities between COVID and climate change. They both have major health risks associated to it, and they also have the potential to undermine the financial system. So whilst business was not prepared for COVID, it seems that there's a real sense of determination that they'll face up to climate change risk and be ready for it and prepare for it. So if we go on to the next slide, please. This slide really just talks a little bit to what we're seeing in different parts of the world. And you see on the left-hand side, there's a degree of consistency, I guess, between various of the regions, the US, UK, Asia, and Europe. I think in Asia, things are perhaps not as well advanced as they might be in the US, and certainly, Ram will talk about this growing sense of urgency that's appearing in the US. So maybe a little bit more education is required in Asia. You'll also see on the right-hand side, how does all this compare with the consumer and hospitality sector? Interestingly, about 74% feel that they understand these risks quite well, and that compares to the global comparison of about 87%. So, there's a bit more to go, it seems, in the consumer sector, to address these issues, which I was personally quite surprised about, given some of the supply chain issues and consumer pressure that Louisa mentioned. If you go to the next slide, please. So whilst corporate leaders feel that they understand that they've got risks to address, what this slide demonstrates or shows is that they probably don't feel they've got all the skills necessary to address all those issues. And you've got about 74% of those leaders who are saying that they need to be better at it or need to improve. And it's all about sort of getting up to speed. And again, there's a parallel with what's happened in other sectors and other issues. You only go back to cybersecurity over the last 5 years, and suddenly on risk manuals of corporates, that's right up there. And we're seeing now that climate risk and climate change is going to be increasingly on those agendas. But of course, it's not easy. It's quite difficult because you've got to take a whole business view of what the impact of this is going to be, and it requires a lot of speed. It requires speed to look at the resilience of your business, to how to finance it, and those are all risks. So, I think we're at the beginning of this journey, of transition. There's lots of knowledge and know-how that's out there, but there's a big education process that's got to happen with businesses, and they have to identify and quantify the risk. They don't just have to look at decarbonising their own business, but they'll have to look at the supply chains. And what we're seeing here in Asia is that there are funds being established by consumer businesses, and they are requiring some of their suppliers now to invest in that fund to then ensure that some of those factories in Asia, which are supplying parts within that supply chain, are operating in a green way with renewable energy. So there's a lot going on here, and it makes for interesting reading. I think the other point just to note is that a lot of corporates are now saying that they've got to build up their internal resources to actually address this. A lot of these issues are very complex, and as I mentioned, they're quite holistic in how you approach it. And so they've got, what we'll see is there'll be an increasing significance of this in businesses, and businesses will start to build their own climate transition teams so that they can meet some of those targets that they have to have and goals that they need to achieve, from which are probably being set in broad senses by the regulators or by investors or external stakeholders. So a lot going on here, and corporates seem to need further help. I'll hand over to Steve Hopkins now.
Thanks very much, Steve. And if we just, we're on the next slide. This focuses a little bit more on the knowledge and understanding of the C-suite. And if we look at the analysis here, is on sort of looking at the job market, the security of your jobs, actually, whether you'd be keeping your job in the next 5 years. And I think that really comes to the crux of it is this just some theoretical risk that we can just put to one side? Or actually, is this something that is really going to change the business? And actually is one where my job security, my role, whatever, is going to be in jeopardy. And you can see from there, the global results, that actually 78% of the board say that climate-based risks are going to be a key factor in whether you keep your job and your performance in relation to that risk, and how actually that plays out within your business and your responsibility you have, not just for your own business, but as we talked already, there is a requirement for you to start looking at supply chains and going beyond just the remit of your own business. Now, I think within the F&B sector, having active for companies over the past sort of years, I know that a lot of retailers have no problems about managing their supply chains very hard. And I think, yeah, we will be seeing that there will be obligations in contracts. We're already looking and doing work with clients about changing their supply agreements to share opportunities and obligations down that supply chain, whether it's audit requirements or it's other things. So you can see very clearly that there is a view that over the next 5 years, jobs, your job will depend to some extent on your performance on climate change, decarbonization, and the transition. If we can go on to the next slide, please. And here we can just look at, as Steve did with his slide, how that compares with other parts of the world, and actually with the F&B sector as well. And it's quite difficult. I've been surprised by these results that there are some subtle changes and differences between different regions of the world, but actually this is just a global problem. It's a global issue, and you can see that more than any sort of major issue I've seen before, that everybody has some degree of recognition and acknowledgement of this. And it is something which globally people are beginning to understand is something they do need to take some action, and it will affect the way they operate. And you can see there within the F&B sector, whilst nobody says that it's highly likely it'll affect their job over the next 5 years, there's 82%, the vast majority say that it is going to be likely that it will be a key factor in keeping your job over the next 5 years. So the C-suite have certainly taken this on board. And as we know, the tone from the top sort of sets the agenda really for the rest of the business. So, it's quite important showing that the C-suite really do think that the success in their role will depend to some extent on their performance on climate change. So with that, I'll pass over back to Steve for the next slide.
Thanks, Steve. So we've talked previously about the need for transparency. There's also a need for scrutiny as well, and we're seeing scrutiny from a whole range of different bodies and stakeholders. So that brings to the fore the need for reporting. And I think what we're seeing here is that the companies that provide public reports on climate resilience are slightly outnumbered by those who don't provide reports. It's I think the stats were 48% do and 51% don't. So it's probably not a surprise, because if you're going to report on something, you've got to understand what you're reporting on, and then you have to quantify what is the risk associated with the disclosures, and that's hard at the moment for some of those companies to do. That said, companies have come a long way, and the Financial Stability Board reports that there's been an 85% increase in climate risk reporting between 2019 and 2020, and we expect there will be continued increases in those reporting standards. But it's not just about reporting; it's about what are the details of the future strategies that will be deployed by those corporates to manage this risk. And companies will become under increasing pressure to report, but they've got to, as I mentioned before, they've got to be able to quantify what are the climate risks and also the opportunities that they've got in their businesses. And then they have to go to the next stage, which is that they've got to then document what is their strategy to address those issues. And that's particularly relevant for if you've got a corporate with an extensive supply chain or a complicated supply chain, you're going to have to drill down into what those members of that supply chain are going to be doing. And I guess you've got to influence their behavior in some manner as well. And I think it's that strategy and that agenda which is going to be really important. And it will get influenced by investors. And I think Louisa had mentioned some of that in her introduction to the report, because investors are going to have to start to decide if they're going to invest in certain assets or not. And then they're going to have to think about, do they want to exit certain asset classes, and they don't want to have stranded assets. And then you overlay on top of that government intervention, which will drive some of this reporting. And I think you'll see that governments will start to use both tax policy and trade and investment policy to influence the way in which this is all heading. So there are lots of aspects to this, but I think reporting is here to stay. But the way in which we do report will have to become increasingly sophisticated. If we go to the next slide, please. won't spend too long on this slide, but it just sort of shows, again, differences around regions. And as Steve said, these are global issues that people are having to deal with, broad similarity across each of the regions. I think the one sort of standout for me in this is if you look at the US and that black box at the bottom there of 84%, reporting seems to be driven in large measure in the US by best practice for companies in that sector. So, it's again doing the right thing and looking at what your peers are doing to drive that reporting behaviour. I'll pass back to Steve.
And this is Rob, real quick. I'll just, on that slide in the US, one thing I will note is some of the companies that we've worked with and seen in the space, some of that driving is also, some of the reporting is also driven by the fact that there are various NGOs and other types of organizations that are actually, grading corporates now on their level of disclosure. You can say you have an ESG, we'll talk about this in a later slide, because you could say, you have an ESG policy or that your board is adopting one. But the level of detail in that policy is really what some of these NGOs are drilling down on, as well as on what's being reported, and also fact checking the reports to see if they're actually factually accurate. So there are some very large names, Fortune 10 type companies in the US have gotten F scores in some of the recent reporting, and they're trying to drastically change some of the reporting protocols in response to those reports.
Yeah, and if we just pass on to the next slide, backing up what Ram's just talked about, who are the people that are likely to be scrutinizing these reports? And there's a whole range of people in there. Some you'd expect to see at the top there, well, insurers to some extent looking at risk, and maybe that's more climate risk that we talked about, but investors, and we talked at length about those, about the change really in mindset to some degree about investing in climate-based climate change companies, those who have strategies in place and those who can show implementation of those strategies, not just something that's on paper. But the NGOs are in there, as you can see, at 23% that Ram talked about. But interestingly, the CEOs believe that there'll be as many employees focused on climate change aspects of policies as there will be the banks and the NGOs, which is very interesting when employees generally look at reporting to see what salaries directors are taking home. So yeah, this is really quite an interesting number there, that employees are certainly engaged with this and are looking at what the reporting is. Customers and consumers down at 8%, which I find surprising, but maybe that's because in different sectors that may be different, but I suspect that number will be building all the time, and that number I think we're seeing. I was very surprised by 8% customers and consumers that I thought would have been higher. If we go on to the next slide, which is then just a compilation again of those by different parts of the world, and interestingly, the one I pick out there on the left-hand side, US investors, those scrutiny by investors in the US, I just think that's changing pretty rapidly there. And I think if we did that again, as Louisa said, we'll be rerunning aspects of this report. I think that number may change, particularly with the change of administration and temperament there. But we'll come back onto that a little bit later on. I think in the F&B sector, still customers and consumers in terms of who's going to scrutinize these reports is down quite a low level, whereas government and regulators, so it's again, are we in compliance with the regulations, because they are going to be looked at by the regulators with greater degrees of scrutiny than they have been. So with that, I'll pass over to Ram. Do you want to pick up from there?
Absolutely, I can do that. Why don't we go to the next slide? So this is just a quick slide. I just want to say, shows, where are we here? I think we're, yeah, so very quickly wanted to show, like a slide here, how this sort of compares across markets. I think a majority of companies, when I ask them poll, they'll say that they have ESG policies they've adopted. that, as we've discussed before, the level of detail and the level of execution and what stage they are for execution it varies quite widely. I will say that one of the other things I think that is interesting from a prior slide in terms of driving some of this is not just the NGOs, the investors, and the banks and the lenders, et cetera, but also, and the consumers, of course, but also I think a sort of healthy sense of competition. I know I saw this early stage with the tech companies when they were first doing this. There is always, what has my neighbor done lately sort of mindset in the tech space. And I think that is rapidly sort of proliferating to other industries, including the food and beverage industry as well. So a lot of companies we see with driving innovation, with respect to, like, for example, we have a client who's driving innovation with supply chain and scope 2 emissions downstream. A lot of their, I wouldn't say competitors, but other companies in the same space are looking at that model and saying, what can we do to adopt this or improve it? And I think that's sort of a healthy competition is another driver.
And Ram, also on that is that there seems to be more companies linking success in climate change into remuneration, which is always a great driver for change of behavior.
Right, exactly. Keeping sort of cognizant of the time. Why don't we go to the next slide? One more, please. Yeah, so I think this is how we want to sort of close out the presentation is, I think the important thing is we've thrown a lot at you with respect to drivers in the industry. There's a lot of factors with respect to, what is driving ESG and decarbonization in the food and beverage industry, as well as other industries. But ultimately, what companies are looking at now is that decarbonization and ESG implementation is actually good for business in the bottom line. It does take a mindset looking long term at corporate governance, because it's some of these investments will require short-term investment for long-term growth. But I think one of the things that we wanted to sort of talk about in this presentation is how decarbonization can be good for business long term, as well as what are the challenges for implementing and executing a successful ESG policy to decarbonize your footprint. And I think we've talked about this, extensively with respect to boards and corporate management taking steps to implement your ESG policies. But there is a host of considerations with respect to how you implement that, as well as I think there's a little bit of a fear among some companies with respect to moving too fast, being a leader in a space, but then getting outpaced by your competition, like I mentioned before, or potentially making an investment that doesn't have the yield that another project or another initiative could potentially have. Ultimately, we see some studies where, I think a lot of these companies are looking at, for example, renewable energy. They're able to procure long-term renewable energy at either the same cost, or in some cases, a discount off of their current, brown power, if you will. In the U.S., for example, a lot of industrials in the food and beverage industry are in the Midwest, and a lot of their manufacturing facilities are run off of old coal plants, because they require a very large thermal load with respect to their plastics and their packaging processes, as well as some of their manufacturing processes. And a lot of those facilities were either gaining free steam or very cheap steam from coal plants, or running auxiliary boilers with natural gas lines, and of course that has a heavy CO2 footprint. What they've realized is they're able to procure renewables and pair it with storage, and potentially or pair it with the CHP, which of course has a single fuel input, which can produce both thermal and electric load, and combine that with solar plus storage or something on site, and actually lower their costs. So not only are you lowering your costs in your production costs, but you're also lowering your carbon footprint while doing so. Energy efficiency initiatives, looking at renewable storage, looking at carbon capture and storage, looking at alternative means for taking olefins and making oxides for plastics, are all means for decarbonization, while being able to potentially, quote unquote, green your products, which of course has other implications in the sense that you might be able to qualify for packaging, green packaging, et cetera, labeling green with respect to FTC Green Guide compliance, which drives sales growth as well in the US. Next slide. Yeah, so I think this is just a slide that quickly shows when in a poll as to what it takes to decarbonize your business. Most of the companies, unsurprisingly, said significant changes are needed to the business model. Let's go to the next slide, and I think that addresses some of the challenges that this slide sort of picks up on. So what are the challenges to decarbonizing? And I think this is the one that we really want to focus on. A lot of companies, I think there's an education process, like we said before. I remember when we did the very first wind VPPA for a very large corporate about 10 years ago, and a very famous CFO got on the phone and said, why the hell are we as a tech company doing a wind PPA? And we had to explain that. And I think a lot's changed since the last 10 years. And more companies, of course, are now gotten savvy to that. But internal stakeholder engagement, internal stakeholder training is very important. I think a lot of companies don't yet understand, fully grasp how to apply the various sort of tools at their disposal to decarbonize. So depending on the industry, depending on the company, depending on where they are with respect to their manufacturing profile, and their energy profile, different companies have different means by which they can decarbonize. So, whether that's, if you're in an area without, deep renewable penetration, renewables may not be an option for you because, the price for renewables may be exorbitant and not economic. If you're in an area with heavy renewable penetration, that's a different calculation for you. There are areas that there are companies now that are looking at hydrogen and potentially, for both transportation use as well as for fuel use. And that's an area that's rapidly growing. So I think there's a little bit of an uncertainty around the cost of decarbonization and really understanding how to get your arms around that. I know a lot of companies have already done energy efficiency measures as an initial step before they go down, and they've actually found most of those energy efficiency measures have a very positive ROI. So that's an easy sort of first step, but depending on the company and their energy profile and envelope, it really depends on the rest of the tools at their disposal. And I think I mentioned this a little. We touched on this a little bit before, that stranded technology, stranded assets. We mentioned with respect to carbon intensive assets. There's also a sort of a fear that potentially you go down the wrong path with a technology like CCS, carbon capture and storage, or hydrogen. Maybe not green hydrogen, but blue hydrogen or something else that isn't as green hydrogen or the next thing that's coming down the pike. And if you invest early, potentially there's a little fear that you could, potentially be left behind by a newer technology. So there's a little bit of that sort of apathy, I think, with some of the companies. But I think overall, as they get wise to the options for decarbonization, more and more companies are realizing that they can't wait on the sidelines, and they are now more and more, investing in decarbonization and actually executing on the strategies. Next slide. That wraps it up for us. I don't know if anyone else, Stephen Hopkins or Stephen Kitts or Louisa, if you have anything else.
Louisa, I'm not sure if there's time for questions, but I had one question for Ram. Obviously, Ram, you're based in the US. With the change in the administration you have, what I was picking up from the ground before the change in administration was that there's a lot of activity, maybe slightly under the radar, going on during the previous administration, which I think now seems to have sort of been allowed to float to the surface, and there's a lot more momentum. Is that how you see things in the US at the moment?
I think that's absolutely accurate. So I do think there's a common perception that the Biden administration comes with a renewed focus on green and being green. I think that sort of initiative and this ESG initiative really started about 10, 15 years ago, really in earnest. And I think a decade ago, truly. So a lot of the initial movers were very large Fortune 10 companies with respect to renewables and with respect to decarbonizing their footprint and for data center development, et cetera. But that has a lot of those companies sort of spearheaded organizations, nonprofit organizations, to drive sustainability and corporate sustainability. And those groups have actually gone from membership of 50, 100 companies to now, the Fortune 1,000. And that has happened gradually over the last 10 years. It was well before the Biden administration, took power. So I think or came into the office. So I think that is something that is absolutely true. I think that the trend has been in place for quite a while now. I do think that there is going to be an increased focus on enforcement action with the FTC and green guides under Biden, generally speaking. I think that's sort of a renewed focus for this administration. But overall, I think the ball's already started moving, and I think companies are sharing information. It's not just competitive. I think a lot of these organizations where companies are coming together, which we're members of, they're actually, presenting on what they're doing, new structures, new deal structures, new technologies that they're adopting. How are they getting their supply chain and suppliers to green up? And doing so in a way that doesn't require changes to their own business model, one of the slides we talked about. So yes, there are things you have to change your business model to implement these things on the front end, but really all you're doing is, the supply chain remains the same. It's really downstream greening that supply chain and decarbonizing the supply chain, and how you do that in a way that minimizes, that minimizes the impact on your current business. So all those things I think have been have been in process, continue to be in process even before the administration change.
Thanks, Ram. Thanks, everybody. Fantastic session, really thought-provoking. So thank you very much for that contribution. We've not had any questions come through the Q&A box, but of course, if anything springs to mind afterwards, or you'd like to reach out to any of the presenters for follow-up, then we'd be very grateful for any comments and commentary, and happy to help. There'll be a recording of this session which will be circulated, so you'll be able to follow up on any of the points mentioned and share within your teams as you would like to. We'll be sending out invitations to the next session very shortly, which will be on competition hot potatoes. So I hope that most of you can join us for that. There will be a feedback survey at the very end of this session, so if you could fill that in for us again, we would really appreciate your feedback. So thank you, everyone, and enjoy the rest of your day. Bye-bye.